Okay, clear? Any issues, any problems?
No, it's fine.
Okay, that's great. Now, basically, most of the chapter involved over here is explaining this. It's not over here yet. It's not over yet. We have to discuss the operating activities discussion as well, the explanation, investing activities, and this financing activities, because they have some kind of paragraphs over here, right? But before that, we will be doing this one, which is called, which I was explaining to you, cash generated from operations, right? So I think this does not have any formula over here in the study text, but I'll write over here in the notes, right? So it's cash flows from, sorry, it was cash generated from operating activities, right? This was the word. You can say cash generated from operations or operating activities, but this is a bit different. Okay, from that, cash flow from operating activities. Both words seem the same, but it's a little bit different because it is a part of that, right? Now what happens is, let me give you a brief insight about this. What happens is that there are two methods of making this cash flow statement, right? One is called the indirect method, second one is called the direct method, right? In most parts of the world nowadays, even the indirect method is being followed, and indirect method simply means this one, this whole format, right? Because in the main syllabus, it contains the indirect method, right? Because you can see that the cash generated from operating activities, I will write the formula in just a while. This also contains, it is the part of the indirect method. The direct method is
Okay,
more
so
simpler.
this is the indirect method.
Yes,
This
yes,
one
exactly,
right
this
here.
is,
Okay.
exactly, this is the indirect method. Okay, now let's read it from here. This is written note regarding the cash generated from operations. So this is based upon a reconciliation beginning with a profit before tax from the statement of profit or loss, right? So every calculation that we do over here is just written in a text form over here, but don't worry, we'll understand it from here, and I'll write the whole format over there in the notes. Okay, so which is adjusted for items included in arriving at profit before tax, right? So what is the purpose of this? I'm writing the purpose of this. The first thing that we studied in this chapter, remember that we have to convert profit into cash at some point in time, right? So the same thing we are doing over here. What we're doing is we are converting the profit into cash. We are making it cash, so that everything, there is a universal rule that we compare like with like, right? So that we are making a cash flow statement, so obviously profit cannot be compared to cash. It will be very unfair, right? So that's why, to make it very fair, to do a very faithful representation over here, what we do is that we compare cash with the cash. So that's why this is included at the very start, because cash generated from operating activities, this is just converting profit into the cash, right? Okay, let's see if there is any kind of the formula over here. It's written, let's see. Again, this is the explanation of cash equivalents, right? Which I already explained to you. Okay, let's see if there is any formula. Just give me a minute. Okay, it's right here. So over here, it has explained each of the things over here, but I will be making it easier. And first, we'll write the formula of this, right? And after that, I'll be explaining you each and everything. Okay. So
And
what we
this
do
is
is,
for the indirect method.
yes, yes, exactly. This only belongs to the
Okay.
indirect method. We will be studying the direct method as well, but that does not involve any calculation. In F3 syllabus, it's just understanding that why we make direct and why we
Okay.
make indirect. Okay,
Okay.
so for this cash generated from operating activities, we start the first figure from profit before tax. This is the first figure because our motive is that we have to convert the profit into cash, right? So what we do is that, if you remember the statement of profit or loss, all the things are minus, right? Like, let's say, depreciation, amortization, interest expense, all of these things, right? Tax expense. So what we do is that they're already minused at arriving to the profit, right? So what we do is we add them back to convert them into cash. Because you see, if non-cash items are being minused to arrive to the profit, if we add them back, if we exactly, if we exclude the effect of them in the statement of cash flows, it will be converted naturally into cash, right? So that's what we are doing over here. Now we start with the profit before tax, right? After that, what we do is we start adding back the non-cash expenses. So first of all, we add back depreciation, right? After depreciation, there may be some kind of amortization as well, right? Because amortization was relating to intangible assets. So we add this as well, right? So two things we have added back. Now, one more thing, we add one more thing, which is called loss on disposal of non-current assets. Okay. Now, how do we know we have to minus it or we have to add the item, right? So you can see loss on this. We have to first consider that how it was being, included in the profit, how profit had the effect of that, right? So when we were calculating profit, if we remember, when we are studying the disposal topic, disposal chapter, we arrived at either profit, either loss, right? While selling a non-current asset. If it was a loss, it was kind of an expense of the company, right? And expense, it decreases the profit, right? So that means expense, this will be basically minus from the profit. So what we'll do is that loss on disposal, every time it is added back, because originally when it was calculated into the profit, it was being minused over there, right? It was deducted. So everything which is being deducted, we are adding it back, like depreciation, amortization, loss. Again, this is a non-cash item, right? Because yes, we have sold out the asset, but loss is like we're not actually paying the expense from our pocket, right? It's just the effect of netting off, right? So loss on disposal of non-current asset is added back over here, right? Now let's see what else we have over here. Interest payable expense, yeah, this is also added back. So interest payable. Now there were two things, right? One is called interest payable, the second one is called interest paid, right? So the word over here is paid and payable. Payable basically means that it is kind of a liability, right? Again, we can call it like a non-cash expense, right? So we also add this amount back over here, okay? Because paid will have been already adjusted in the normal cash flow format that we studied, which was cash flow from operating activities, right? You can see the tax and the interest, both things are minus over there, but this is interest payable. It is a bit different from that, okay? Then after that, yeah, we have three more things. These are very interesting to understand. Let's do them. So first, let me write them. Increase or decrease in inventory, then increase or decrease in receivables, and finally it's increase or decrease in payables. So these were the last three things, okay? So what we do is, for converting the profit into cash, we are doing all this effort over here, which is called cash generated from operating activities. Okay, now let me explain you what this means. So what will we do? Will be minus this, will be plus this. Let's understand this. And I'll not only just write it and then just ask you to write this down on your notes. I will explain you each and everything logically, like I'm doing from the last from the first chapter, right? So over here you can see increase or decrease in inventory, right? Now if you think, first of all, we'll consider the increase part, okay? If we have to basically join everything, we have to link everything to which thing? We have to link everything to cash over here, okay? We have to see the effect on everything on cash. Now if we are increasing the inventory, for increasing inventory, this means that we are buying more inventory. If we are buying more inventory, if we are acquiring, purchasing more inventory, that means we are increasing the inventory, right? Because inventory cannot go up by itself, right? We have to purchase it for increasing it. So you can see, if we are increasing inventory, that means we are purchasing it, and for purchasing, the cash goes out of the business, right? So what we'll do is that increase we will minus over here, right? So increase will be minus. And if you consider the other aspect over here, which is decrease inventory, if we are decreasing in inventory, that means that inventory is being sold out, right? If inventory is being decreased, the customers are buying the inventory very happily, right? So if customers are buying, we are getting cash, right? So if we are getting cash, that means naturally cash will be increasing, right? So decrease in inventory is always added back into this, right? Because these three does not have any adding back effect or any kind of thing like that. We are just including these three things to make it real cash, because these
Okay.
three things also have an effect, a direct effect on the cash. Okay, so this was increase, decrease in inventory. Now let's consider the same thing for receivables. Now, first of all, let's see increase, right? If there is increase in receivables, right? So if there is an increase in receivables, that means more of the sales are being happened. And in receivables, what happens is the more the receivables we have, the less the cash we'll receive. Because you can see in receivables, we don't receive the cash right now. We receive it after 1, 2, 3, 4 weeks, right? After 15, 20 days, right? So increase in receivables means that our cash is being blocked, right? We are not
So we have to
receiving it.
minus.
Exactly. Increase, we will have to minus over here because the cash is being naturally blocked over here. We will not have access to receivables over here. Okay, so this will be minus. Now, decrease in receivables naturally means that when receivables will be finished off, what will be the double entry? Debit cash, credit receivables. Receivables will be finished, and what thing will be received? Cash, right? Cash will be received. So decrease in receivables has the same effect as inventory. Decrease means addition, increase means minus of cash. Okay, but the only thing that is opposite to inventory and receivables is this payable one. Okay, now if we consider again logically, right, nothing we have to memorize, everything we have to understand over here. Okay, now increase in payables, if you consider increase in payables, that means we are purchasing more, right? And if payables are being increased, what happens is that we are gaining more, you can say, access to the cash, right? Because the more the payables we have, the more the late payment goes to them, right? The more the late payment goes to them, that means more access to cash for more days we have, right? Let's say there was one payable and we had to pay him in 7 days, 1 week. So that means the payable, basically payable period was very less over here. So it was again linked to that last day topic that we studied, that was interpretation ratios. The more the payable period we have, that means the more access to cash we have, right? Because the more the payables, the later we'll pay to the suppliers, and the later we'll pay to the suppliers, more access to cash will be with us. So this is the only thing which is opposite. So in this case, increase for payables will be added over here because it increases cash. It increases our access to the cash. And if you consider the other aspect, which is decrease in payable, right? So what happens is that decrease in payable means that payables are now being finished. And what is the double entry for payables being finished? Debit payable, credit cash. So in return, what are we paying? In decreasing payables, we are paying cash, right? So that means cash is going out of the business in this case, in decreasing payable. So decrease will get minus in this case. So therefore, decrease will be deducted. Okay, right? So this was the whole explanation for that small topic. Yes, it is a little bit of effort, but again, same thing as consolidation. Don't expect that you will be given with the whole section B question of this, and you will have to make the whole statement. It's nothing like that, right? Yes, in F7, hopefully we'll be looking, you will be looking at this chapter in more detail. Like we have to, prepare it on Excel and everything. But it's very simple over here. The answer that we get over here is called cash generated from operations, which is the first thing that we include in the first head of the cash flow, which was cash flow from operating activities. Okay, right? Got it? Clear? Any questions?
Yes. No, thank you.
Okay, have you written all of this or do you need time?
Just one moment.
Okay, sure, sure.
Okay, done.
Okay, that's great. So let's do first of all the explanation of this one. It's written over here. You can see indirect method, right? Let's first discuss this, right? So the indirect method of presenting cash flows from operating activities relies upon information that is disclosed in the financial statements or can be calculated from information disclosed in the financial statements. It's a very vague statement. The starting point is normally profit before tax, which we have already done, right? So this is basically explaining all the things that we've already done in these notes, right? Now let's start discussing each and every one of them. Depreciation. So this is added back to profit before tax because it was a non-cash expense. So I told you everything which was minus from profit, during calculating the profit, we have to add them back, right? Loss on disposal, I also explained you this. This is also, minus, so that we add back in this cash flow, right? Interest payable as well, added back to profit because it is not part of cash generated from operations. The cash payment is deducted elsewhere in the cash flows, right? Because we studied it in the statement. So that's why payable, we are adding it back. By adding back, we basically mean we are eliminating it. We are excluding this because the netting of entry will be the same in this case, right? So interest payable is not what we consider over here. That's why we exclude this, but we looked at paid over here, right? Because there is a major difference. You can see this payable word is connected to the accruals concept, right? And paid word is concerned connected with the cash basis, right? Because paid actually means that we took out our wallet and took the cash out and actually paid it in physical form, right? But payables actually mean it's just in our mind, it's just on paper. We actually are planning to pay it. And this is exactly the concept of accruals concept that we have studied, the arrears part and everything, right? Now, increase, decrease in inventory, I don't think there is any need to discuss this because if we read it from here, you will be more confused because I have already given you an adequate explanation over here. And
Sorry,
I hope you're,
I've not understood that one. The interest. Sorry, okay, can you back to?
yeah, yeah.
Thank you. Payable. Oh yeah, it's payable. It's a liability, so we haven't paid for it yet, so it's not a cash.
Yeah, yeah, exactly. You can understand it like
Okay,
that as
that's
well.
fine.
Exactly.
Okay, yeah, okay.
And this, I hope you're clear about this. The increase, decrease inventory, the
Yes, it's
payables,
fine. Yeah,
receivables. Okay,
yeah.
great. Okay, again, there is a long question. No need to do this because it's just for, understanding purpose. Let's do this one. Cash from operating activities. This was the first head, right? And after that, we will be looking at the further things. So cash flows may include two things. If you open the format in front of you as well, you will have to revise these as well. Interest paid and income taxes paid, right? So now we are actually, entered in the fences of cash, right? Because we have exited the profit, we have entered into the country of cash now, right? We have crossed the border of profit now. So what happens is that everything is related to cash, and the same thing I explained you, that now everything will be paid everything, nothing will be payable over here because payable was considered with accruals concept. Okay, now calculation of interest or income taxes paid. So there is a little bit of, you can say, common sense involved over here as well. We use some of the T accounts in this case because in some cases the examiner might not give you a ready-made amount, right? So in that case we will have to use a T account to calculate that. Okay, so directly looking at the T account over here, this is basically interest or tax payable account. Okay, so this is again which account? Liability, right? This is liability account. Now, if we remember, if we have like an interest payable, so what we write the opening balance on the debits on the credit side, right? And the closing balance is written on the debit side, right? Now, this can be used, don't be confused over here, this can be used in the interest part as well and the tax part as well, because both are payable, right? Both are expenses and both are payable, so you can use them both interchangeably. Okay, so what we do is that we write the opening balance and the closing balance, right? We write the interest charge. So interest charge basically means the P&L figure, right? The profit and loss charge that we have included. And when we net off all these things, we get a cash paid over here, which is on the debit side. If you remember, it's very similar to that concept which we studied, accruals and prepayments, right? We studied two T accounts, right? The expense and the income one. So it's very similar to that.
Sorry, why the interest charge
Because you can
go?
see there are two different things. We don't have to include the profit or loss figure, we have to include what is actually being paid, right? And not in every circumstance the actually paid figure is coming into the profit or loss, right? That does not happen in every case. So that means the safer option over here is to consider the cash paid, because this is the same, if you remember from accruals and prepayments, the cash paid is written on the debit side. It's a
Yeah,
balancing
but
thing.
the interest charge, that
Mhm.
one going to pay it, right?
Yeah, because look, interest charge is basically, we can say, expense for the year, right? And expense for the year and actual cash can vary in some terms as well, right? Let's say if I had to pay, let's say, TV subscription, and that was my expense for the year, right? And let's say for 12 months it was 800, right? But actually the cash I paid, let's say I had in my wallet only 500, right? So I had no other option just to pay 500. So the actual cash paid and the item in the profit or loss, which is expense, is a little bit different. That's what we discussed over here, right? Because that is regarding the accruals concept, right? That considers the accrual concept, and the cash paid, actually the cash paid, that is considering the straightforward techniques of cash over here. Okay, so if you want to understand this, you can understand. If you want to memorize this T account, because this is the only option we have to calculate the tax payable, the tax paid, and the interest paid. We make a payable account just like a liability. We write
So
the
basically, on the debit side,
Mhm.
it goes to the cash paid. All the other things are on the credit side, right?
Yes, exactly, except the closing balance, because the opening closing
Yeah,
are over here, and you
yeah,
write
yeah,
the
yeah.
expense charge, which is the separate one, to the cash paid over here, right? Because expense for the year is very different to the cash paid. Like I just give you the example, like my expense for the year may be 800, but I only paid physical in cash of 500. I may ask the person that I'll pay the 300 in the next year. So that means the next
Okay,
year will be 800 plus 300, right? 1100. And that's what we studied
okay.
in the accruals and prepayments, right? So
Mhm.
this eliminating this concept, we take the actual cash paid that is actually being paid from our pocket. Okay, so this was the T account for interest or tax. You can use it for both interchangeably.
Okay.
Okay, right now let's go on to the next one, the next heading, and after that we'll surely take a short break, right? This is the second part. As you know, this is called investing activities, right? So for investing, you remember that investing activity contains those things in which we were investing as a company, right? Now these contains a lot of things, like cash outflows may include purchase of property, right? Like land, building, everything we're purchasing. Cash inflows may include interest received, dividend received. I gave you the explanation for these as well. Like, let's say investing activities, what happens is that we're investing in any company. We may invest in a bank. We may, give loan to someone. We are earning interest from that, right? We may invest in a company as well. From that, we are receiving dividends, right? And proceeds as well, because at one point of time we have to sell the property, plant, and equipment that we bought, right? For selling that, the proceeds of that definitely will be coming as a plus in the cash flows, right? Now you might be wondering, why did not we write, because these all things were interconnected when we studied the disposal chapter, right? So disposal chapter had profit or loss as well, proceeds as well, depreciation as well. So the thing that we have to consider over here is that why did not we write the loss or the profit over here? Because that was included in the profit figure, right? Profit before tax. That's why I included it over here, which was basically the journey to profit to cash, the journey from profit to cash. That's why I included it over here. Loss on disposal of a non-current asset. Although it is related to this, it is very much similar. But the thing is that we have to, consider the things that were minus from the profit in arriving, right? But proceeds do not come under profit. So that's why we have to consider them separately over here. Okay, got it. Now, similar terms, the similar thing that we studied above for tax paid, interest paid, exactly the same thing happens for this as well. This is interest received and dividend received. So in this case, what we do, we make an account which is called interest receivable, or we can say dividend receivable as well, right? Above, you saw that we make a payable account because that was paid expense, right? This was an income. So for every kind of income, there is a word receivable, right? So over here we make a asset account, which is receivable account, right? Receivable is an asset, so that's why we write the opening on the debit, closing on the credit side. Same thing is happening. What we do is the P&L figure goes over here, right? And the cash received figure, the actual cash received again, is being written on the opposite side. So these things are exactly same as accrual and prepayment chapter that we studied. This is kind of like an income account, right? And the above one was like an
Sorry,
expense account.
just write this down. Sorry.
Okay, sure.
Okay, done.
Okay, that's great. So now let's discuss the last over here, right? And let's see what's it's talking about over here. So calculation of purchase of property, plant, equipment. Yes, this is also very important because in some cases, because look, basically what the examiner is trying to test you over here, that do you know the other concept that we studied from the start, right? Because the reason that these statements, the consolidation, the cash flows, interpretation, all of these things are included at the end are, you can see that the same T accounts are being made. In the payable one, we also looked the interest and tax payable. The dividend received, we also looked, right? Interest, dividend received, because these were exactly the T accounts we have already spent much time in the start, right? So examiner is not only trying to assess the cash flow topic, but also the T accounts that we have studied in the start, right? So in this case, it will be same one in some cases as well, that for calculating what actually property, plant, equipment we bought, the examiner can confuse you a little bit, and it can ask you, you can say it can give you like three amounts, like the cost for the year, the closing cost, the opening cost, right? The accumulated depreciation, the closing carrying value, opening carrying value, right? So regarding these, we can also easily, very easily calculate this if we know the T accounts format that we have studied from the start, right? So you can see these kind of T accounts we make, right? This is the carrying amount T account. We just have to pay attention. We'll do some questions as well of this one. I'll tell you over there as well, that in carrying amount, if there is information given for the carrying amount, we have to just consider the carrying. Either it's opening balance, either it's closing balance. We have to take nothing regarding the cost. Okay. So in this way, because carrying amount is different to cost. Carrying amount is basically cost minus the depreciation, and cost is just the cost, right? So you can see that in some cases, insufficient detail is provided to produce separate asset and accumulated depreciation accounts. So instead, a carrying amount account can be used if these two informations are given separately. We'll understand the practical part of this once we do the question. I understand it can be a bit confusing to understand right now, but when we'll go to the questions,
Yeah, I'm just
it,
going to write this down.
yeah, sure, sure. You can write it down. After that, I'll explain.
Okay, done.
Okay, that's great. So let me explain you this, that what it means. So over here, you can see that again, it's a carrying amount account, right? So we just have to include the carrying amounts, not the cost. So basically cost minus the accumulated depreciation, because these three things are separate, like cost, carrying amount, and accumulated depreciation. So what we do is the opening balance, obviously it's an asset. So we write the opening balance on debit side, we write the closing balance on credit side, just like normal, right? We write the disposal, but the disposal amount we write at the carrying amount, because again, the phrase I'm repeating, the phrase was always compare like with like, right? So because this is a carrying amount T account, that's why we are writing the disposal at the carrying amount. Okay, let's say the information was given in the question, the carrying amount of the asset that we sold was 50,000, right? The depreciation that is charged till date, let's say it was 10,000, right? And the cost from which we purchased it was 60,000, right? So it is being clear that if this is the carrying amount account that we're making, we will have to include this one, this 50,000. Yes, this will be the disposal, but this disposal will be included at the carrying value. And if we minus the cost from accumulated depreciation, we'll also get this amount as the answer, right? So again, everything is compared to with like. So that's why if we are creating a carrying amount um, account, we will have to include everything relating to the carrying amount. Okay. Then depreciation charge is also written over here, because you can see the plus is over here, the minus is on the credit side, right? So depreciation basically reduces the carrying amount, right? So that's why it's written on minus. Revaluation, obviously, yeah, this is also included. If the asset is being increased in value, then the revaluation we write, right? And additions at carrying amount. So this is the balancing figure that we'll get over here, and this will be actually the carrying amount additions that we get. Additions mean that the actually the assets that we purchased over here. Okay, right? So this was
Yeah,
the explanation for
we
carrying
have to
amount.
practice this, otherwise it's not